The Federal Reserve, often simply called the Fed, acts as the central bank of the United States. Its primary role is to manage the country's economy to keep it stable and growing. Think of the Fed as the economy's guardian, working behind the scenes to prevent it from getting too hot or too cold. To do this, it has a dual mandate assigned by Congress: to promote maximum employment and to keep prices stable, which means keeping inflation under control. These two goals can sometimes be in conflict. For instance, actions taken to boost employment might inadvertently cause prices to rise too quickly, creating a delicate balancing act for the central bankers who make these crucial decisions. The most powerful tool the Fed uses to influence the economy is the federal funds rate. This is the interest rate at which banks lend money to each other overnight. While you, as a consumer, don't pay this rate directly, it has a ripple effect across the entire financial system. When the Fed changes this benchmark rate, it influences the interest rates on a wide array of financial products that directly impact households and businesses: credit card rates, auto loans, home mortgages. On Wednesday, September 17, 2025, the Federal Reserve announced a significant policy shift that had been widely anticipated by financial markets. The central bank's policymakers voted to cut their benchmark interest rate for the first time in 9 months since the last adjustment in December 2024. The decision was to lower the rate by 1/4 percentage point, or 25 basis points. This move brought the new target range for the federal funds rate to between 4% and 4.25%. While the cut itself was expected, with market probabilities standing at 96% ahead of the announcement, it marked a crucial turning point in the Fed's strategy for managing the U.S. economy. This rate cut was a direct response to a collection of economic data that suggested the economy was losing momentum after a long period of robust activity. For months, Fed officials had maintained a cautious stance, holding rates steady to assess the lingering effects of past hikes aimed at taming inflation. However, growing concerns about the health of the labor market and a general slowdown prompted them to act. The primary motivation behind the Federal Reserve's decision to lower interest rates was the clear and marked slowdown in the U.S. job market. For months, hiring data pointed to a cooling trend, a big change from the red-hot market of recent years. Chair Jerome Powell highlighted these concerns, saying downside risks to employment had risen. He called it a curious balanced supply of available workers slowing down demand from employers slowing down. That created a softer, less dynamic labor market that worried policymakers. This slowdown wasn't just theory, it was changing real business decisions across the country. Companies that had been aggressively hiring were now becoming more hesitant. Job creation slowed substantially, and some sectors even reported modest layoffs. The Fed, charged with ensuring maximum employment, saw this as a serious warning sign. A weakening job market can trigger a vicious cycle where worried workers cut back on spending and businesses pull back further. The Federal Reserve's decision was made against a backdrop of intense and sustained political pressure, particularly from President Donald Trump. Throughout 2025, the president repeatedly called for the central bank to cut interest rates significantly. He argued that lower borrowing costs were necessary to juice economic growth and to keep the United States competitive globally. Days before the meeting, Trump posted, "Must cut interest rates now bigger than he had in mind." This public campaign put the Fed in a politically sensitive spot. Despite that, Federal Reserve officials, led by Powell, have consistently asserted institutional independence. Central bank independence is a cornerstone of modern economic policy, allowing decisions based on long-term data, not short-term politics. At his press conference, Powell said the Fed remains strongly committed to maintaining our independence. He stressed the rate cut was driven solely by the economic outlook. The situation was complicated by personnel changes at the Fed. The lone dissenter was Governor Stephen Moran, sworn in just 1 day before the meeting. Moran, a former chair of Trump's Council of Economic Advisors, highlighted internal divisions. The quarter-point reduction was a measured, data-driven step, not the large cuts Trump sought. The immediate reaction in the financial markets was mixed. It was, honestly, pretty volatile. Initially, stocks moved higher on the news of a rate cut. The Dow jumped about 450 points, roughly 1%. But that optimism soon faded. Investors digested the details and Chair Powell's cautious tone. Major indexes gave back gains. The S&P 500 ended nearly flat. The tech-heavy Nasdaq closed down 0.3%. This choppy trading shows investor uncertainty. One area that saw a more direct positive impact was the housing market. Mortgage rates were already falling before the meeting. For the week of September 11th, the 30-year averaged 6.35%. The Fed's cut reinforces that trend, relief for buyers looking ahead. The big question is, what the Fed will do next. Officials released an updated dot plot mapping policymakers' rate expectations. The dot plot signaled more cuts are likely. The median forecast shows 2 more quarter-point cuts in 2025. That implies a cut at the Fed's October meeting and another at the Fed's December meeting. This signals the Fed is prepared to act if the economy keeps slowing. Investors will now watch every jobs and inflation report closely as the Fed's next meeting approaches.